We're going to review some facts and figures about life insurance, and then we'll move into how life insurance works, what it is, and why you might need a policy. And then we'll break down the different types of life insurance and discuss permanent policies. And to end, we'll walk through 3 ways to utilize some little known benefits of life insurance before moving on to Q&A. All right. So just some facts and figures, some pretty important stuff that came from this really great 2024 study. But since back in 1960, 72% of Americans owned individual life insurance. So that's non-employer or employee paid through your company. And then today it's closer to 52%. And then if we look at that over the next one is the loss of a primary earner. So nearly 1/3 of Americans would feel the loss of the primary earner, and another third would have no idea how they would pay all their expenses if something happened to that primary or the breadwinner. Okay. Couple other really good ones in here, but the main reason for people owning life insurance is to fund funeral, burial, or other end-of-life expenses, such as what we call income replacement. So there's a huge gap out there right now because the thought is life insurance is just way too expensive. So we're going to kind of break that down and what that looks like a little bit later on in this webinar here. So one cool fun one is life insurance does get more expensive as we get older. And just like as Kim Hubbard said, as fun as like life insurance, the older you get, the more it costs. Okay, so really important. A lot of people look at life insurance as just a cost, which it does cost money, but ultimately in here, we also want to know, how life insurance works, what it is, and why we would need life insurance. Okay. So long ago, we figured out that there's a strength in numbers. For hundreds of years, people have been joining forces against all kinds of calamities, including financial troubles. So the idea behind insurance is if enough people can pool their money and form a large enough fund, then together they can handle practically any financial disaster. So this kind of works across all different insurances. But today, the motivation for contributing to this fund, aka paying your premium for life insurance, and then your eligibility to draw off of it if that disaster, end of life, happens. And so it's kind of that all for one and one for all, so to speak. Okay, so that's how the life insurance works, is essentially we're pooling all these premium payments for insurance, and when something happens to an insured and they're paid out this death benefit, it's covered by all these premiums that have been paid by everybody, right? And so what is life insurance? So basically, hold on one second. So the cost and availability of life insurance really depends on different factors. Let me see here. Hold on one second. I'm messing up here. Okay. There we go. Sorry. The cost of life insurance and availability depends on a lot of factors. With most financial decisions, there's expenses associated with the purchase of life insurance. And so we just really want to make sure, but it's a contract between an insurance company and a policy owner governed by state law. So life insurance or insurance in general is definitely done by the states. So under the terms of the contract, you pay the premium in exchange for the promise of payment of money to a named beneficiary when the insured person passes away. Okay. So insurance is an exchange of money. And when a policy is purchased, you're taking on a specific risk. And let me one second. So when we look at this, a question we often get is, can anyone buy life insurance for anyone they want? And so if we have the parties to a life insurance contract we have the owner, it's the person that owns the policy, the insured, that's the person that we're paying the premium for if something were to happen. And then a primary or contingent. Primary beneficiary is the first person, contingent gets the money if something happens to the primary before the insured passes away. So again, the question that we get often is, can anyone buy life insurance on anyone they want? And the short answer is no. but because you must have what's called an insurable interest on the person being insured. So the big example of this is family insuring the breadwinner, or even a business owner insuring employees key to the future success of a company. Um, all right. And so why life insurance? So big point is there's many uses for life insurance. And we always say just be careful to buy the right type of policy for your specific need. Okay. And there's three main uses for life insurance. Okay. First one is income replacement. This is the biggest one that we see across the board. So if you've just started out a family and you've got a couple of kids, one kid, and you're either the primary breadwinner or something happens to you, you want to make sure that your family is taken care of. That's what the income replacement is for. Basically, we go from either two incomes or one income to zero. That's where the life insurance can come in. And it's just replacing that income stream that's not going to be there anymore. And the second main type is for inheritance. So life insurance offers what's typically a tax-free death benefit, income tax-free death benefit. So it's a way to leave a more efficient inheritance down and potentially even levered up on the amount of money you put in versus what comes out. And the third main use is for estate taxes. Not as big of a deal today for most people with new estate exemptions and everything that we'll go through later. But a big thing here is that it's a way to cover estate tax without in a more efficient way for some people. Okay, so now that we kind of understand why we might buy life insurance and what it is, let's look at the different types of insurance here. Okay, so life insurance can really be broken up into two main categories: term and permanent. Term, temporary, meaning for a term of time. So the names kind of give it away, but the main differences between term and permanent are temporary coverage for term versus potential lifetime coverage for permanent. And you can kind of choose the amount, and it's typically for term, it's a level death benefit, meaning if you wanted to go get $1 million of death benefit, it's going to stay that way for the term, typically 10, 20, 30 years. You can also choose a decreasing. Think of that as like mortgage protection. If you bought a $300,000 house and you took out a $250,000 loan for that house, you could start a life insurance policy at 250, and it decreases along that amortization schedule of your loan. Okay. From a permanent side, you can choose the amount, and some allow increasing coverage. There's typically two types of death benefit there. One is level and one is increasing. So there's different ways to do that depending on your insurance need. Term insurance offers the lowest initial premiums, but after that term, if you got $1 million for 10 years, after that 10 years is up, there's still the availability to pay for that insurance. It's just going to get vastly more expensive each year after that 10-year term. So while your premiums may be a little bit higher on the permanent, or are a little bit higher on the permanent is a better way to say that. A lot of times we do that for certain reasons, such as cash value accumulation, tax-free income later in life, but also to make sure that we have the insurance coverage down the road. And again, speaking of that cash value, term insurance carries none. So you pay your premium, that covers the cost of the insurance. In a permanent life insurance policy, you typically grow a cash value, which we're going to get to here in a minute. Okay, so term insurance provides that simple and affordable way to protect your family financially in case of an untimely death. And these are all the different reasons why you might take out a term life insurance policy. Okay. And again, we kind of do this for a set period. If you just had kids, maybe we want to make sure we get through both raising them and college. So that might be 25 or 30 years. Or if you're doing this a little bit later, you already have kids that are a certain age. Maybe we only do 10 or 15 or 20 years. Okay. Sometimes we just want to make sure our spouse is taken care of. So we want to make sure that if something happens to us, that they're taken care of, and that might be more of a permanent policy, but could also be a term with a little bit longer duration in there. Okay. So again, the pros, just lower premiums compared to permanent coverage, provides coverage during those critical financial years where we're accumulating our assets. Underwriting, which is how all life insurance policies or most life insurance policies go through underwriting. And what that means is that they're going to look at how much of a risk they think you are to prematurely passing away. And right now with term insurance, we've got tons of different, or there are a lot of different insurance companies out there that are doing what they call accelerated underwriting. Basically, you go through a checklist, and if all the answers look good, then we can place the coverage typically within three to 5 business days, which is really great. Now, there's always considerations with everything we do financially. And some of the considerations with term insurance are that there's no cash value or investment component. So it's like your car insurance or your home insurance, you're just paying money for it. And if you never need it, you just lose it. So that's something to always think about. That's one of the biggest considerations with term insurance. Okay, so now permanent. Okay, there are 2 main types of permanent policies, whole life and universal life. And what we see a lot is that these kind of get talked about in the same light, even though they are kind of vastly different types of products. So we're going to kind of walk through those today. Okay, so whole life has 2 main types that they offer, and universal has 3 different main types, and it all is determined by how they credit interest to the policies. Okay, whole life offers a set death benefit along with the savings component under a fixed premium that's for life of the policy. So universal life, offers a guaranteed minimum death benefit as long as your paid premiums cover it, with the flexibility of adjustable premium payments. Okay, variable life is the same, but the variable life is tied to the market or investments, and so there brings in a component of risk, what we call market risk. And then index offers kind of that variable death benefit if we want that, typically growing with adjustable premium payments as needed, with interest rates linked to an external index like the S&P 500, but offers downside protection with interest rate guarantees and caps on the gain. So again, we're going to walk through this a little bit deeper, but essentially the biggest difference with these 4 different types is the way that they credit interest to the policy. And for this particular webinar, we're going to look at whole life, the variable universal, and the index universal. Okay, whole life. There are 2 main types of whole life policies, participating and non-participating. In a participating whole life insurance policy, the policyholder is eligible to receive dividends from the insurance company. These dividends are typically paid out annually and are based on the company's financial performance. It includes the investment returns and their claims experience, essentially. So, but policyholders can use dividends in various ways, such as reducing future premiums, increasing the cash value, and purchasing additional coverage or receiving them as cash. Okay, there's potential to earn dividends that can increase policy value or reduce costs, but dividends are not guaranteed and depend on the insurer's performance. Non-participating whole life insurance is more predictable and straightforward with guaranteed benefits, but offers no opportunity to receive dividends, limiting potential cash value growth or future cost reductions. Okay. So, whole life insurance provides coverage for policyholders' entire life with a guaranteed death benefit paid to beneficiaries upon death. It also has a cash value component that grows at a fixed rate, typically guaranteed by the insurance company. Policyholders pay a consistent premium, part of which fund the death benefit, while the remainder contributes to the cash value. Over time, this cash value accumulates tax deferred and can be accessed through loans or withdrawals. The policy is credited through fixed interest payments determined by the insurer, which guarantees a minimum rate of return. Okay? Some whole life policies may also earn dividends from those insurance companies. Again, those are the participating, which can be used to increase that cash value, reduce premiums, or purchase additional coverage. So again, one of the big things I always like to say here is, again, with anything we do financially, there's pros and we call them cons, but I like to call them considerations, is essentially where we see whole life use a lot is on very young people and they're just growing this cash value. It does tend to be a little bit more expensive than other options. All right, so we're not talking about a regular universal life today because there are so many different ways that it works. But essentially, before we jump into the variable life, I just want everyone to know a regular universal life policy has a minimum guaranteed interest rate that credits from the insurance company, set by the insurance company. And we use those as a fully guaranteed death benefit, typically later in life when we're doing things for estate planning or tax planning. So the reason why we're not talking about those is because they're typically used way later in life for different situations than the normal. So when we talk about variable universal life, it allows for flexibility of premium payments while also being able to increase or decrease the death benefit based on your financial situation. Policyholders can allocate the cash value to a range of investment sub-accounts, typically like a mutual fund, but of stocks and bonds, while offering the potential for higher returns compared to whole life for standard universal life policies. Okay, so essentially, variable universal life insurance ties the cash value growth to market returns, which brings a level of investment risk into the policy. Okay, there's a risk of losing value if the investments perform poorly. Okay, so VEL policies tend to have higher fees, including management fees for the investment sub-accounts. Again, very similar to mutual funds. They have administrative costs on the policy, and obviously the insurance charges for the cost of insurance eating into those returns. Okay, they bring with them a level of complexity with the investment options, fees, and potential risks, which require financial knowledge and a good advisor to help manage. If the investment sub-accounts are not managed properly, the growth can become inconsistent, whether it be from volatility of the markets or just poor investment decisions themselves. Index universal life. So this is probably the one, what we call an IUL, but this is the one that's probably talked about the most in the last 10 to 15 years. So they've kind of come into play over that time. And we've seen a lot of use with this. And we're going to actually talk about a use of this later on down in this webinar. So, but within an index universal life, very similar to a variable universal life, except instead of being in sub-accounts, again, basically like mutual funds, your cash value grows based on the performance of a stock market index. Again, big example is the S&P 500, where it ties it to that and offers higher growth potential compared to any fixed rate policies without direct market risk due to the downside protection offered with a guaranteed minimum interest rate. So let's put this in non-financial terms. Essentially, there's a floor on if the market, the S&P 500 performs badly, negative, there's a floor of somewhere between 0 and 2% typically. So meaning that even if the market went down 20%, you're not losing because the market went down. Fast forward that on the upside of that, so if let's say the market goes up 20%, we're not going to take all 20% of that growth. We're going to get capped 10, 12%, depends on the policy and what those caps are at. Right now, with today's high interest rates, we do see very high caps in the double digits there. So these policies can be very good, but like all UL policies, the flexibility of premiums allows for changes dependent on your financial situation. And the tax-deferred growth of the cash value over time can create a little bit more efficient accumulation. So, and there's different index options, not just the S&P 500, and we can choose those allocations throughout the year. But they tend to be pretty complex. Okay, so there's caps on the gain, there's floors on the market return, there's something called participation rates, which you participate in an index at a certain percentage. So the interplay with those and premiums and the cash value component can just create some complexity. So if it's something that you're interested in learning more about, please just give us a call. We're happy to discuss those different. But Again, the big thing with the IULs are the downside protection. Um, and even though it's a cap on the return, typically that can smooth out our returns over time. And so there's been a big uh, there's been uh, a big movement to these over the VULs over the last 10, 15 years. Okay, so when we talk about life insurance, it comes off as a way of something we just have to pay for. And then if we do have to pay for it, well, how much do I need? Well, it's a fairly easy calculation that we can look at is, if you make 50,000 a year and you want to replace all 50,000 a year for 20 years with no market growth, we need $1 million, right? That's 50,000 a year for 20 years is $1 million. So that's one way, kind of easy way to look at it is, if that's what we want to replace, that's kind of what we need over a 20-year period. Now, we could throw growth rates in and we could do all these things, and that calculation becomes a little bit more complex. But ultimately, what we like to use is what we call the needs analysis. And so what this does is literally tells us where we need, okay? And for those that recognize the two names of these clients, I'm a big Friends fan, so we're using Chandler and Monica in here. And so what we're looking at is we've put together a plan for Chandler and Monica that shows, where they're at currently and where they're growing to. And if something were to happen to Chandler tomorrow, how much insurance would he need to hit their goals later in life, for Monica to be able to take care of the kids and all of that. Okay. And then we do the same for Monica. If Monica were to pass away, how much insurance is Chandler going to need to make sure that their goals are hit down the road? Okay. And what that looks like is we determine the impact either for retirement or raising kids or both. So in the instance of this needs analysis, we're just looking kind of at retirement. And so basically showing that, if Monica and Chandler are, younger in their 30s or 40s, and they need this income later in life, here's how much shortage you're going to be. We're talking, okay, let's say we're saying, 20 years until retirement, and then another 25 years of retirement. We're talking 45 years that we've got some growth in there, and then we've got drawing from the account. So we're going to look at this across everything in here to determine how much Chandler passing away could impact Monica, the rest of Monica's life. Okay. And same thing for Monica. We're going to look at her as well and show, okay, maybe because Chandler makes more money, if Monica passes away, he still has this higher income. So the impact to retirement isn't quite as much. Okay. So we don't need quite as much insurance on Monica. So we're going to look at it, getting her a policy, but maybe a little bit lower. So the big thing here that I think a lot of, whether it's an insurance agent or advisors, where they get it wrong is overinsurance. So we're just paying for insurance that we technically don't really need. And so it's a fine line between getting enough and not having too much. And so putting together analysis on that really helps us with figuring out or determining what is the right amount of insurance. Okay. So if it's something that you've been thinking about getting coverage over and above any company sponsored plans, this is something that could be very beneficial. Again, at the end of the presentation and in a follow-up email, I'll send out a way that you can get on our calendar and talk about your unique situation, and we'll walk through needs analysis with you. Okay. All right. So now a couple of things in here when we look at unlocking the power of life insurance. So a big thing with life insurance is, again, the normal thought with life insurance is it's coverage for if something happens to me and my family's taken care of. Again, very great one, the main need of life insurance there. But there's different things with these life insurance policies in today's world that a lot of people just don't realize are there. And so I wanted to go through 3 of these with you today that can really, really help some people in certain situations. So first and foremost, life insurance has something called living benefits, and not all insurance policies have this, but a lot do. Typically the permanent policies. Okay. So they offer living benefits such as chronic, critical, and terminal benefits. Okay. And we'll explain those here in a minute. And then there's wealth transfer and estate planning. Again, not a need for every single person, but it is something, and we're going to walk through a couple little powerful strategies there that you can set up if legacy is a desire, especially if passing that money down efficiently is a desire in today's lower tax rates. Okay. And then tax-free income. Okay. This is a powerful strategy. And if you've sat on any of my webinars in the past, we'll talk about this from time to time for those that are a little bit younger, mid to late 50s and younger. This is a powerful strategy we can use to employ to just kind of diversify from that normal stock, bond, cash mix that we typically have. Okay. So first, the power of the living benefits. Okay. So basically these provide crucial benefits that can enhance the financial security during challenging times. And again, most of these benefits just come with the policy. There are no additional cost or anything. And so the chronic illness rider lets you access part of that death benefit if you're diagnosed with a chronic illness that limits your daily activities. The funds can help cover long-term care, medical bills, and other expenses, kind of giving you flexibility and control over your care. Okay? The terminal illness rider provides early access to your death benefit if diagnosed with a terminal illness, usually with 12 or 24 months to live, depending on the company. Okay. This helps pay for medical or hospice care and relieves that financial stress while allowing you to make important choices about your final months. Okay. And then the critical illness rider pays out a portion of your death benefit if you're diagnosed with a major illness like cancer, heart attack, or a stroke. Okay. It offers that financial support for your treatment or living expenses, helping protect your savings and giving a peace of mind so you can focus on recovery. And so very important thing to note on all of this is almost 100% of the time, these benefits, these living benefits that you get come from the death benefit, so they're tax-free. Okay, so it's just an early access to that death benefit. So if we take some of these funds out to cover any of these terminal, chronic, or critical illnesses, it just reduces the death benefit for what your family is going to get. Okay, so, but very powerful tools for those looking at either adding some type of coverage in their later years, even early years, but later years, and covering some of these if we wanted to get some funds out for stuff like long-term care or cancer or anything of that nature. Okay, so wealth transfer. So I just really wanted to talk about this because there's a few things that came out with this one big, beautiful bill back that was signed in July, but it introduced some temporary tax changes along with some permanent changes to the tax code. Okay, so tax brackets have been permanently locked in at today's levels, and rates are locked in at an all-time low. Okay, so in case of wealth transfer, the estate tax exemption has permanently been increased to 15 million per individual or 30 million per couple and begins in 2026. So this is a slight increase from what we've seen in the past, but a huge increase, almost double what was expected if this bill didn't pass for 2026. So the higher exemption amount means that the majority of Americans won't pay estate taxes at the federal level when passing money down to future generations. Okay, state taxes, which inheritance tax, anybody in Texas like us, we don't have an inheritance or state estate tax here, but some other states do. So there might be some planning things you need to do there. Okay, but one thing of note, when the tax code changes are made permanent like this, it doesn't mean permanent forever. It just means permanent until the next administration comes in and they're able to make changes if they can get the majority of Congress to pass that. So while it sounds great, these changes too could be temporary over 4 to 5 years. But so one big example I always like to say here is right now it's 15 million per individual. and the top estate tax rate is 40%. Just 20 years ago, it was $1 million exemption with the top tax rate of 49%. Okay, so when we look at the estate tax exemption, particularly, it's very important to realize that it's one of the highest changed tax codes out there because you never feel it. It's not something that you pass away and it's your family feels it. So we see it change quite often. And so it's just one of those things to be cognizant of if you've got a decent sized portfolio and you haven't done that in the next 4 or 5 years, we could see some big changes there. Yeah. Okay, so a couple other quick things here. If you're 65 or older, the senior $6,000 deduction starting this year, 2025, you get an extra $6,000 per person. So if you're married, that's $12,000. There are phase outs of this starting at about $150,000 for joint. So there's some other things we can do to lower that tax rate with that deduction. And anybody familiar with state and local tax exemption or deductions, that's SALT. This increased to a $40,000 from $10,000 that it was in previous years. There are phase outs of this too, and it starts at $600,000. And so of income. So for those that haven't been able to itemize their property tax or anything, there's things there. So not that that's part of life insurance, but I just wanted to update people on that while we walk through this enhanced estate exemption. Okay, so when we talk about that wealth transfer using life insurance, if anybody is familiar with a Roth IRA conversion, we've talked about this on past webinars, but I'll kind of talk about it very quick. A Roth conversion is essentially we take traditional IRA or 401k and we move it into a Roth IRA or Roth 401k. We're going to pay our taxes in that year that it happens. And now all the money that we have in that Roth grows tax deferred and is tax free when we take it out in retirement, given that we hit 59 and a half and had it for more than 5 years. Excuse me. So can be a very, very powerful tax planning strategy, specifically in today's low tax rates. Okay. When we look at alternatives or something that we do in addition to Roth conversions is we also look at from a wealth transfer standpoint, we look at moving money into a life insurance policy because it also is extremely efficient for passing money down. With a Roth IRA or Roth 401k, and when somebody inherits that, the next generation inherits that Roth account, they'll have 10 years to take it out under today's rules. So while it's very efficient, it does all have to come out in 10 years. No tax on it, but it has to be out. With the life insurance policy, we can move that stuff into an account and it can stay there and continue to grow forever. So there's different trade-offs, no required minimum distributions, but we get that leveraged death benefit. So it's going to be higher than what we put into it at some point in the future. Okay. So these are things to think about if, again, legacy or wealth transfer is something that you're considering and want to look at deeper. And then one way that we do this specifically to avoid estate taxes is what we call an irrevocable life insurance trust. And so this is something that we use. It's a little bit more complicated, but I wanted to bring this out because it is a way that you can get the money in and get it. It's always going to be income tax free to your heirs, but nothing is that's not estate tax free. This gets it out of the estate, and so it's important that if you do have a little bit higher estate value or plan to in the future, these are things to look at if we're transferring money over, because like a Roth IRA is in your estate, so it could have estate tax in the future if that exemption falls quite a bit. Whereas if we put it into this, it keeps it out of the estate and keeps it both income tax free and estate tax free. So real important there, but again, a pretty in-depth one that takes quite a bit of financial planning to go through. So if it's something, again, that you really want questions on, we typically bring in estate attorneys and CPAs just to make sure everything's going right in the tax and estate plan there. So, but if you want any more information on that, please feel free to reach out to me. Okay. So a couple more slides here, guys, and then we'll be done. But I really want to talk about this creating tax-free income because this is something that's been around a long time, but it's really grown in popularity over the last decade. And so it's basically using a permanent life insurance policy to provide both life insurance coverage and a tax advantage retirement income that comes from the policy's cash value via loans, which we'll talk about in a little bit. Okay. So a life insurance retirement plan, or LIRP as we call it, is a financial strategy that involves using that permanent policy, typically whole life or index universal life. If anybody's ever heard of Be Your Own Banker or stuff like that, those are marketing terms for basically the same thing. Okay. But it's again coverage for life insurance and retirement savings. And so the cash value grows without being taxed, which can be a significant advantage over taxable accounts. And then when we take loans from the policy in the future, the withdrawals can be structured to be tax-free, providing that tax-efficient income in retirement. And that's something for each person, if that's an interest that we'll walk down. But you can take money from the cash value and growth is going to be taxed, or we can take a loan from the policy and it's going to be tax-free. And then we can structure it so that it never has an issue of running out of money. Okay. So the policyholders can access the cash before retirement. There's no required minimum distribution. And but there is an impact to that death benefit a little bit as we take money out. We'll see the death benefit lower. So while life insurance retirement plan is a great vehicle and provides that guaranteed death benefit, it's not something that we want to, if we want to maintain a big death benefit in the future, that's not the right type of policy for that. Okay. But a big thing too here was when we talk about the long-term care benefits via the living benefits, very important considerations there are that they're there for us as we're accumulating the money. But as soon as we turn on that tax-free income, those accelerated benefits we will not use those anymore. So we want to look at all that when we're creating this. But essentially, the point of it is we've got our retirement portfolios, or we're growing our retirement portfolios, and they typically have stocks, bonds, cash, maybe a little bit of real estate. For those a little bit older, maybe some annuities. This is a way to bring in a separate asset class of life insurance that can provide some tax advantaged income. Okay. And just kind of want to show you what this looks like. This is a sample life insurance retirement plan illustration that kind of shows we're going to put in $12,000 a year or $1,000 a month as a savings vehicle. We're going to do that from age 45 to age 64, so for 20 years. And we're going to grow. You can see on the whole life and the index universal, you can see that cash value growth. Again, remembering back to that, the index universal life has the downside protection and the cap on the growth, but overall versus kind of the fixed with maybe some dividends from the whole life policy. And so over the long term, the index policy typically performs better, but it is related to that market, the S&P 500, the market, whatever it's tied to. So, but when we look at that, we put this in for 20 years, and then we're going to wait 1 year. We're going to let it cook for a year, and then we're going to start pulling income from this, okay, tax-free. And what this looks like here is because that cash value is just a little bit lower on the whole life policy, the amount that we can pull out is just going to be a little bit less, okay? Where the index universal life we see is a little bit higher. Now, I just want to put this in context too, whether it's a whole life or an index universal life, the cash values are what are going to drive this, okay? The death benefit's higher here, cash value lower. That's that cost of insurance is going to be higher, thus the income's going to be lower. We've got a lower death benefit here, higher cash value, the income's going to be higher. So again, and you can do this with a variable universal life as well. And so depending on where those values are is what's going to determine the amount of income we can pull out. Okay. So in this case here, we've pulled out $33,000 a year for 20 years, vastly more money than we put in, all tax-free. Now you can see the death benefits are lowering and eventually become so little that, they're really just covering, afterlife expenses like funeral and burial. So this is not something that we set up for providing a huge benefit in the future from a life insurance standpoint, but we have to have the life insurance coverage because it is a life insurance policy. So if something were to happen and the insured passed away at age 70, this is the tax-free death benefit that would pay out to the beneficiary. So the money that we put in, 240,000 over 20 years, is leveraged up tax-free even after we got a little bit of income. So they can be very good, but there's always considerations with anything that we do. Okay. So first is a cost. Permanent life insurance policies can be or more expensive than term, and especially when they're structured for cash value accumulation because we're putting more money in. And the complexity is usually a big one because LRPs can be complex, requiring careful management to avoid lapsing the policy or triggering taxes. So that's something that you've got to make sure that if you're going to do one of these and you work with an advisor or life insurance agent, make sure that they have stuff in place to continually manage these through the years because they are very long-term strategies. Okay. And then returns, the growth in the cash value might be lower compared to other investment options, depending on the type of policy and market conditions. Very important there. Again, when we talk about the different types of investments, stocks, bonds, cash, real estate, life insurance, it's a different asset class. So we can't expect it to perform the exact same as some of the others. We want it to perform in various different ways, and that's that diversification. Okay. So, and then policy loans is really the big one. Again, if not managed carefully, the loans from the policy, they can reduce the death benefit, or they do reduce the death benefit and potentially cause the policy to lapse. So, which leads to taxes and penalties. So, today we add what's typically a free or very inexpensive rider called an overloan protection rider. And that assures that the policy doesn't lapse due to loans. But that gets missed from time to time from some people. So if this is something you're going to look at, just make sure that's involved with it. And then, of course, underwriting is everything, right? So they're going to look at your health. They're going to look at the risks that they think you are to the insurance company. All insurance companies cover risk differently or define risk differently. So underwriting can cause that too. The higher you're rated, the better. So the healthier you are, typically the better. And the better that life insurance retirement plan is going to look. And at some point down the road, it's just cost prohibitive based on the cost of insurance to do that type of policy. So underwriting is definitely a consideration there. Yeah. And again, if you have questions on that or want to know anything further, because that's a very high level look at those, please just schedule some time with me and we'll get through there. Okay. So a couple of next steps for you guys, and then I'll let you guys get back to lunch and to work. Just some action items on life insurance in general is just learn about the coverages you already have in place. Okay, so very important here is, do you have employer coverage? Do you have coverage that you can buy through your employer? What is the cost of that coverage? And then shop that out after you understand your budget. Just see, what is my income? What are my expenses? What's my budget for getting additional insurance? And then we need to determine your need, okay? And whether, again, you do a very straight line, this is what I want to replace for this period of time, and just kind of straight line it in. That's one way, the easy way, the simple way. If you want the needs analysis, again, work with your advisor, give us a call. We're happy to help there. And then prioritize that risk. We can't go buy all the insurance in the world, and we can't overbuy everything. So because everything else that you need to invest in, save for retirement, save for that future home, save for your kids' college, whatever, that's going to get hit a little bit because we're overpaying for insurance coverages. So, and then overall, have a plan. You're never too young to have a financial plan. It's going to be simple. The younger you are, save as much as you can here. But having that plan that says, here's my risks and here's how I can combat those. That's very important for a lot of people. I've never had anybody in my 20 years of doing this for a living, never had anybody said they planned too early. Okay, it's always planned too late. So just something to think of there. Okay, and when we say that again, comprehensive financial plan, risk management, life insurance, tax planning can be life insurance, estate planning can be life insurance. So those are all different things that kind of cover in there, but we want to make sure that we're covering your risk, your estate is planned to make sure you pass that down um, to your family, to your heirs, to charity, to whoever that may be. Taxes, very important. If you guys have ever heard me talk, taxes is one of the most important things to me because so much gets left on the table. We leave so many tips to the IRS. And so tax planning is a big one. Investment management. Investments have become a little bit more commoditized in these days, but there are still ways to make sure that we can, get those to grow over time, get you in the right set depending on your risk levels. And then setting those goals. What are our intentions? What do we want to have happen? How do we want to do that and have that plan go there? So very important to have those. If you don't, there's tons of tools out there online. Your advisor should have some. And again, we're happy to help if you need us to. Okay. So with that, if you'd like to schedule some time with me individually, scan the QR code. That'll get you right over to my calendar, or you can email me any specific questions you have. And with that, we'll go ahead and take some questions if anybody has some of them. Let's see, we've got a couple. Okay, first one is, I keep seeing ads about selling your life insurance policy. What's your take on this? Oh, okay. Great question. It's a little bit different than what we're talking about today. When somebody is asking you to sell them your life insurance policy, it's essentially you're selling them to be the owner and the beneficiary of the policy. So when you pass, they make the money on it. And for that, the trade-off of that is they give you money now. So the healthier you are when you do that, the less money you get from it because they're going to have to typically wait longer to get that death benefit payout. Those are called life settlements, viatical settlements. So there's a couple different markets there. And so typically where we see that is people that are much older that don't need the insurance anymore or need the income right away to pay for something. So, but yeah, that's typically, you won't find too many companies that are buying those for younger people. Great question. Okay. Next question. Is there a maximum that we can put into a life insurance policy? Typically, no, not technically, no, I should say. There's not a maximum amount you can put in. A couple different things here on life insurance is they have something called the 7-pay test, but it's determines if the contract is a modified endowment contract or not, or what's called a MEC. And essentially, the IRS stipulates how much we can put into a life insurance policy per the death benefit. Okay, a couple different tests of how we can determine that. But if you can put in more than that, but what it does is it creates what's called a modified endowment contract, which means the death benefit is still tax-free, but any other benefit from it is going to be taxable. So no loans, no anything like that, we could use that for. So real important there is we have to have the insurable interest, and the life insurance company isn't just going to give you a maximum amount of life insurance. They won't going to want to see your financials at that level if you're putting in a ton of money into it to make sure that the amount of insurance that they're giving you is sufficient for, or is not too much for what you have. So great question. Okay. I've heard this, next question. I've heard this about invest or buy term, invest the difference. What's your take on that? Wonderful question. So, you're going to hear both sides of this everywhere. Okay. And so to me, it's always dependent on each individual person and plan. So term, again, is the cheapest way to get insurance coverage. And then if you invest the difference, clearly over time, the market tends to do really well. And so you have this money sitting there versus do we buy the permanent insurance and either raise that cash value and let that grow? How do we do that? And the answer is it's going to be dependent on your situation. It all breaks down to math, and math can be manipulated in any way we want to show that this one's better than the other. But ultimately, as long as if you need the insurance coverage, as long as you're doing one of them, you're way better than probably 60% of people out there. So if you buy term to invest the difference but don't invest it, then maybe that's not as good of getting the permanent policy. So those are the kind of the thoughts there that we have when we talk to people about that. But so yeah, wonderful question. And again, if you Google search that stuff, you're going to find so many different opinions on that. And so that's something to think about. Okay, let's see. Okay, let's see. One more question. What is the cost expense ratio for a policy? All right, wonderful question. So it is going to depend on the insurance company. Every insurance company, again, has their different charges and things, but the easiest way to talk about it is what we call the cost of life insurance, or excuse me, the cost of insurance and the net amount at risk. Okay, so let me go back a couple of slides here to just easily understand this. Okay. All right. So when we look here, we're going to look at the the cash surrender value screen on the Index Universal Life. Okay. So essentially, let's look at year 20 here. We've got a $390,000 cash value and a $572,000 death benefit. So what that means is there is $82,000 difference between the cash value and the death benefit. That $82,000 is what's called the net amount at risk. That's what you're paying for cost of insurance. Okay. So the higher your cash value, the lower your cost of insurance per that death benefit. So if we look at year one, we have a $193,000 death benefit and a $5,000 cash surrender value. That net amount of risk is $188,000. That's what you're paying cost of insurance on. So as we get older, the cost of insurance goes up, but as your cash value grows, the net amount at risk goes down. So typically most expenses in life insurance policies are in the first 10 years. That's where we see the majority of those. But depending on it, can be a little less than that or a little more than that. But we'll see the slowest cash value growth in that first 10 years, typically because of that cost of insurance. And that net amount of risk is higher. But then after that year 10, as the net amount of risk starts to fall, we see a little bit greater growth. And that's why we always say anything we do in something like a life insurance retirement plan, even a VUL, anything like that, they're long-term strategies, right? We're not thinking 5, 10 years down the road. We're thinking 15, 20. So those are things to be very cognizant of. Great question. All right. So that looks like all the questions we have. Again, please feel free to reach out to us here at the Noble Group. We're here to help as part of working with you guys on the 401k side. So we look forward to talking with you soon. And next month, our webinar will be on estate planning. So anybody that wants to be in that, we'll be sending out that invite here in the next couple of weeks. So thanks again for joining us today. Have a good rest of your day, and we'll talk with you soon.